Good morning, everyone. I'm Teresa Torres, the Chief Diversity, Equity, and Inclusion Officer at the New York Fed. Welcome to an economy that works for all, fostering low-income homeownership. Thank you for joining us today. Please note that the comments of all Federal Reserve staff speaking today are those of the presenters and do not necessarily reflect those of their respective Federal Reserve banks or that of the Federal Reserve System. I first have a few housekeeping remarks. Speaking lines are muted. For optimal viewing, click on Layout, which is located on the top right-hand corner of the video panel, and unselect Show Non-Video Participants. Closed captions are available via the multimedia viewer on the lower right-hand corner of your event window. Please select Continue to view them, then enter the password FRB Home 1118. That's FRB Home 1118. An ASL translator will be featured alongside speakers throughout the webinar. You may pin them to your stage for better viewing. This event is being recorded for later viewing on our public website. Here at the New York Fed, our vision is to be at the forefront of anticipating, adapting, and acting in a fast-changing world to shape an equitable and resilient economy for all. That vision was in the foreground as we planned today's event. Knowing the role home ownership plays in wealth building, we wanted to bring together nonprofit executives and bankers, joined by research economists, supervision leaders, and community development professionals from the New York Fed to understand the challenges facing low-income home buyers and what can be done to better foster low-income home ownership. Today's event will focus on the latest research on forbearance and refinancing, the reality of first-time home ownership and community-led solutions, and conversations with bankers about home ownership inequities. It's important to note that low-income individuals and families are, every day, realizing their dreams of home ownership thanks to the work and guidance provided by several of the organizations speaking today. We think it's important to learn from successes in the field, so we're especially grateful to them for joining us. I'd like to thank all of today's participants, and I'm hopeful that we'll all leave with a greater understanding of what can be done to ensure more low-income Americans can unlock the door to wealth building through homeownership. Now I would like to introduce my colleague, Andy Howitt, Senior Vice President in the bank's research team. Over to you, Andy.
Thank you very much, Teresa, and good morning, everyone, and thanks to everyone for being here. It's my pleasure to introduce this morning's first panel, which will present some research findings related to low-income and minority homeowners. I'm going to introduce the panelists and then say a few more words. The first panelist is Dong-Hoon Lee. Dong-Hoon is a research officer in the microeconomic studies function at the New York Fed. His primary research interests include housing economics, household finance, and labor economics. Prior to joining the New York Fed, Mr. Lee was an assistant professor at New York University. He holds a PhD from the University of Pennsylvania. Our second panelist today is Paul Willen. Paul is a senior economist and a policy advisor at the Boston Fed, where he's worked since 2004. At the Fed, Paul has studied housing and mortgage markets with an emphasis on the causes and consequences of the housing boom and bust of the 2000s. His recent work focuses on the distributional outcomes in the mortgage market. Paul holds a PhD from Yale University. Now, like me, both of these presenters are Fed economists. When I first joined the Fed a long time ago, it might have seemed odd to some audiences to hear Fed economists talking a lot about issues related to the distribution of income and wealth. Those economists generally seem pretty devoted to understanding the macro economy, things like GDP and inflation. So what's brought on this sudden interest in low-income households and households of color? Well, I'd like to say a few words on that subject. The first thing to say is that this interest isn't really all that sudden. The work has always been there, even if it wasn't as substantial or highlighted as much as it is today. Still, there's no doubt that there is more work on distributional issues in the Fed than there used to be. and there are a few reasons for that from my perspective. First, it's very clear that our actions at the Fed often affect the outcomes of different households very differently. Dong-Hoon will talk about how the widespread offer of mortgage forbearances has had these kinds of differential effects, and how the end of that program will be especially consequential for certain kinds of especially lower income households. Second, our ability to affect aggregate outcomes at the Fed can depend on the distribution of income and wealth in the economy. Paul's results on the effects of lower interest rates on refinances by race indicates monetary policy isn't as effective as it could be if the refinance channel were equally open and used by all. Finally, at the Fed, we're part of the community, and it's the right thing to do. We're an institution with a lot of analytic firepower, as you're about to see, and this gives us a big advantage when looking into these important questions. Since we're part of the community, it's really important that we do this. And with that, let me ask Dong-Hoon to get us started.
Good morning, everyone. Welcome to the event. As Andy introduced, I am Dong-Hoon Lee, a research economist at the New York Fed. I am very happy to present our work with my New York Fed household debt and credit team on mortgage forbearance and low-income households. The presentation is of our views only and does not represent the view of the New York Fed or the Federal Reserve System. Next, please. So here is the roadmap of the presentation. We present our findings on mortgage forbearance affecting low-income home ownership. Home ownership is the most important means of asset accumulation for low and middle income households in the US. In the advent of a pandemic and economic crisis, CARES Act provided forbearance on federally backed mortgages, which was initially for 1 year and is now extended to 18 months. Their borrowers may enroll by contacting their servicers or lenders, and CARES Act also put a moratorium on foreclosure starts. So in this presentation, we focus on the development of mortgage forbearance participation, forbearance exits, mortgage delinquencies for the nation, and also focus on the lower income neighborhoods. Next, please. Mortgage forbearance rate peaked in May of last year. It was over 7%, and since then gradually improved. The green line represents the mortgage forbearance rate, and the red bar, inflow into forbearance, and the blue bar, exiting forbearance. There was a big increase in forbearance enrollment in April and May of last year, and it was declining since then as outflows were higher than new enrollments. Next, please. Now let's look at the mortgage forbearance by different income areas. So lower income areas in the red line have the highest mortgage forbearance rate, but all areas saw improvement. Aside from the lowest income area, the other three income areas below, making up the 75% of the population, had lower forbearance rate, but still significant. Next, please. Now let's look at what lower income areas look like compared to the rest. They have annual average income less than $46,000. They have lower number of mortgages and smaller mortgage balance, and this is reflecting lower home price and lower home ownership rate there. The aggregate mortgage balance in the lowest income area is only 1/4 of the highest income area. So $0.9 trillion compared to $3.9 trillion. And this is indicating that the potential benefit exposure in aggregate terms is smaller in the lower income area. Lower income area has higher share of FHA loans and has relatively lower origination credit score, which is 716, but nevertheless, this is very high in historical perspective. Next, please. So if we compare different races instead of income, then what would it look like? Not surprisingly, given that there is a strong correlation between income and race, we see a similar pattern. White majority area, which is blue bar, show the lowest forbearance rate, and Black and Hispanic areas in the red bar show higher rate, and all race groups show an improvement between last year and now. Next, please. To show this in a more granular level, we show the New York City map of forbearance rates by zip code. The left panel is as of June last year, and the right panel is as of September this year. We see a general decline in forbearance rates across all areas. Lighter color represent lower forbearance rate, and darker color represent higher forbearance rate. Cross-sectionally, we see the alignment of income and forbearance. Higher income Manhattan area with lower rate, and certain lower income areas with higher rate. Next, please. Then what predicts forbearance rate the best? Among many variables we looked at, we find that origination credit score is the most important predictor. Higher credit scores with lower rate of forbearance and vice versa. And as in the previous chart, income and credit scores are strongly correlated. Next, please. As the purpose of forbearance was to help borrowers to stay off of delinquency, we see that mortgage delinquency rate declined across all income areas as troubled borrowers participated in forbearance and avoided delinquency. Next, please. So since troubled borrowers are either delinquent or in forbearance, so let's define stressed mortgages to be the sum of the two. And we see the share of stressed mortgages jumped sharply in the early last year and declined over time. And then they are now approaching the pre-pandemic level, even though it is still somewhat elevated. As 4% of lower income area, the mortgages are in forbearance or delinquent. Next, please. As the forbearance program nears an end, then what do we expect to see among the 2 million borrowers still in forbearance? Will they resume making payment, which would be a good outcome, or transition into delinquency, a bad outcome? We wouldn't know for sure until the program ends, but we can see their characteristics to have some prediction. We expect the remaining borrowers still in forbearance to transition into delinquency with higher rate, higher than those who have already graduated from forbearance. And the reason is, as more than half of them have been in forbearance more than 1 year. So here you see the distribution of month of staying in forbearance among these borrowers. And there are many borrowers who are in forbearance for the entire duration since April of last year, as you see on the right side toolbar. Next, please. Despite the unprecedented economic shock caused by COVID pandemic and its resulting financial difficulty, so far it looks as if homeowners were very resilient to economic challenges with distressed mortgages share between 2 and 3%, which is a very different pattern from the mortgage crisis 10 years ago, when more than 10% of mortgages were seriously delinquent. This resilience is aided by federal mortgage forbearance and other fiscal stimulus packages, but then there's another factor behind this one. We know that the relatively prompt resolution of the potential mortgage crisis came at the expense of home ownership, especially at the lower income level, lower income area. As we all know, the housing crisis 10 years ago resulted in much tighter credit standards and limited access to home credit. So unevenly so in lower income area. So as a measure of home ownership, the lowest income area had about 20% of total mortgages 20 years ago, back in early 2000s, but now they account for 15%. Next, please. So this is the conclusion, and then my time is up. So thank you for listening to me, and I'll pass it to Paul Willen. Thank you.
Can you Okay, I'd like to thank the organizers for inviting me and on behalf of my collaborators to come to speak at this important event. Let me reiterate that I'm speaking today as a researcher and as a concerned citizen, and not as a representative of the Boston Fed or of the Federal Reserve system. So the starting point for this is that there recently has been a lot of attention on the gap in interest rates paid by Black and white borrowers when they get mortgages. And to a lot of research, including my own, on whether there's evidence of discrimination at origination. And the answer is there is. I think the consensus is there is some evidence of discrimination, but the differences are small. They're in the single basis points. But when we look at the gap in, so that's the gap at origination, but if we look at the gap in outstanding mortgage rates, so this is looking over a period for which we can identify the race and in our mortgage data, the gap in the rates that borrowers get when they get new loans is small across races, but the gap in outstanding interest rates and interest rates of all outstanding mortgages is large. And in research we've done over the last year, we've argued that the fact that we see these big differences in the outstanding mortgage, so the fact that the typical Black homeowner is paying 40 basis points more for a mortgage than the typical white homeowner, has to do with differences in the speeds with which they refinance their mortgages. And in particular, as I will show you, it has to do with the sensitivity of borrowers to the incentive from the rate reduction that the borrower can get for when they refinance. And we show that you can explain most of these differences have to do with observable characteristics like credit score and loan to value ratio and income. But the result of this is that monetary policy, which now, and this has been an innovation in the last 20 years, works through, directly tries to work through lowering mortgage rates for households. What I'll show you is that those benefits tend to go to more to white households than Black households, because white households are more likely to refinance. And so you can see here, if we look at the Fed funds rate over time, when the Fed funds rate goes down, the gap in mortgage rates between white and Black households goes up. Okay, and so this is just a simple picture. This just shows you, this is the path of the probability that a borrower will refinance in quarters since the loan was made. And you can see that all throughout the life cycle of the loan, white borrowers are more likely to refinance than Black borrowers. However, this gap that would be problematic in some ways to begin with, but what's important is when the white borrowers refinance, not so much that they refinance. And so what we have on the x-axis here is, in a sense, the value of refinancing, how much your lifetime wealth goes up when you refinance. And basically what you see here is that white and Asian borrowers, when the gains to refinancing are small, there are small differences, but when the gains to refinancing are big, that's when we see these gaps emerge. And so as an example of this, if we go to 2008, when the Federal Reserve first introduced MBS, first intervened directly in the mortgage market, what we see is on the day that we announced that we were going to intervene in mortgage markets to lower mortgage rates, there was an 80% increase in applications from white borrowers, but only a 25% increase among Black borrowers. And you look over the next 5 years, where we had an unprecedented program to lower mortgage rates. And you can see this is the hazard refinancing for Black borrowers, and this is the hazard of refinancing for white borrowers. And if we overlay on here the different programs that we did, QE1, QE2, QE3, you see that when we announce these programs, we see a big gap emerge in the refinancing probability for white versus Black borrowers. And so let me conclude by talking about what's happened during COVID. So as many of you know, there's been a huge wave of refinancing now to take advantage of what are even lower interest rates. Everybody thought in 2010, 11, 12, that there would never be mortgage rates that low again. And in fact, now we have mortgage rates which are much lower. And again, the same pattern has emerged. We see these are for loans for borrowers with loans from Fannie and Freddie, and these are for borrowers with loans from FHA. You can see here again, we see the same pattern emerge. When the low interest rates start, which is here in February and March of 2020, you see this gap emerge between Black and white households, basically with taking advantage of the lower rates. And so finally, just to say, we did a calculation here, and I don't have time to go through this thing, which most people probably can't even read, but you'll just have to trust me that what we show here is basically, if you look at, we estimate how much money households saved by refinancing, and of the gains of the reduction in payments. So we estimate there's $5 billion in annual reductions in payments. What we show is that less than 4% of the Black households, or probably about 15% of households, of those gains, less than 4% went to Black households. And I think that I'm out of time. So thank you again for giving us this opportunity.
Thank you so much, Andy, Dong-Hoon, and Paul, for sharing your research and your insights. It really was, very, very informative, and we appreciate you joining us today. Now we'll be moving on to our community development panel that will be led by Tony Davis, Community Affairs Officer and Director of Community Development. Over to you, Tony.
Thank you so much for that, Teresa. And good morning, everyone. I am Tony Davis, the Community Affairs Officer for the Federal Reserve Bank of New York. And I'm in the Community Development Unit, where we work with cross-sector leaders to better understand and ultimately address systemic challenges faced by underserved communities. That's why I'm very pleased to serve as the moderator for an important discussion that will highlight the reality of homeownership and community-led solutions. We are honored this morning to have three highly regarded community development practitioners with us today. We have Bernell Greer, who is the Executive Director from Impact Brooklyn, which is a community development corporation committed to helping residents build and sustain flourishing communities in Fort Greene, Clinton Hill, Bed-Stuy, Crown Heights, and Prospect Heights, and I'm sure other parts of Brooklyn as well. We also have Mike Lofton, who is the CEO of Homewise, a nonprofit social enterprise promoting sustainable homeownership in a way that improves the long-term financial well-being of modest income families. And we also have Noelle Melton, Vice President of National Homeownership Programs and Lending at NeighborWorks America, where she leads efforts to support financial stability and wealth building through strategic planning and program development. So we invited our panel of experts to discuss the barriers of homeownership for first-time home buyers, share ways of navigating mortgage forbearance for existing homeowners, and to discuss the capacity building efforts they are seeing and promoting to support organizations and lower income communities build wealth through home ownership. So now that we've set the stage, let's hear from our esteemed panelists. So I want to start with Bernell Greer. Burnell, can you help frame the discussion by highlighting 2 or 3 socioeconomic disparities that exist as barriers for lower income families to own a home?
So thank you, Tony, for allowing me to frame the social economic barriers. First, let me qualify. My work has focused in New York City and for the past 5 years in Brooklyn, New York, where Impact Brooklyn concentrates its work. The families that we work with are working families and largely Black, Indigenous, people of color, BIPOC is the new term, that sometimes do not fit the CRA guidelines of low income. So the short answer to social barriers and what we are all too often reticent to flesh out is racism and economic equality. There is no racial equity without housing equity, and there is no racial justice without housing justice. But of course, there is more. Buying a home is an important milestone, but unfortunately, it is one that too many hardworking families across New York can't reach due to decades of discriminatory housing policies. For Black and Brown families in search of a home, it can be nearly impossible to afford or secure the money for a down payment due to a system that has historically made it challenging for communities of color to build wealth. Today's Black home ownership rate is as low as it was when redlining was actively practiced. The Latino home ownership rate is 25 points lower than the white home ownership rate. Exclusionary federal housing policies primarily benefited, and we just saw it on the slides before, benefited white families, giving them easy access to federally insured mortgage loans designated to make homeownership more affordable. In the first 35 years of the FHA insured program, only 2% of loans guaranteed by the Federal Housing Administration went to Black and Brown people. So the lack of down payment is a major barrier to home ownership for families. Many Black and Brown consumers have sufficient income to pay a monthly mortgage, but what they lack is intergenerational wealth because exclusionary federal housing policies prevented their families from being able to access home ownership. These families have been unable to gift a down payment to successive generations.
Thank you for that, Burnell. And I just have a very quick follow-up question for you. How do these realities counteract with current requirements for homeownership?
So the down payment, as I mentioned before, being able to have the money for down payment closing cost assistance, to be able to have that equity. A lot of the challenge even too, in terms of being able to have the work, the job, to be able to have credit score. And I will say too, that even for myself, because a lot of this is very personal in nature, recently, just going through the refinance process, we don't look at other things that might happen. Who is the appraiser coming to your home and looking and whether or not there's disparities, even in terms of how homes are valued and being able to get the true value of your home. So there's a lot that just goes along with the overall process, and it really continues. We would think that a lot of this would have stopped by now, but we continue to have challenges that have existed for centuries, actually.
Yeah, thank you for that framing, Burnell. So Mike, do these barriers resonate with you coming from New Mexico, and what else are you seeing in terms of disparities?
Well, I think Burnell is dead on the historic patterns of racism in the country, which we legally discriminated against, giving people mortgages up until the Fair Housing Act in 1968. It's a huge driver of all of this, right? Because if your parents didn't own a home and your grandparents didn't own a home, where does that down payment help come from? So if you don't have that, we need to level that playing field. And so that's the role of the public sector to say, no, there should be a way to help people with down payment whose parents aren't in a position to help them. I think the other is, even use of credit. I was, a personal story on this, I was walking around with my son who just bought a home a couple years ago in New Orleans, and he goes, yeah, all my friends are surprised that I bought a home at like 26 or 27. And I go, like, why is your credit so good? And he goes, well, I can tell you why my credit's good. It's because you and mom got me a credit card in college, so I had a way to pay bills, and you guys paid it. And so it would pay on time. So he built a great credit score. Well, if you don't have parents in a position to do that, or have access to credit, that doesn't happen either. I think the real challenge is to level the playing field for the people who've been left behind. And that means, I think, creating a delivery system that reaches people in an effective way around their best interest. It's, there was outreach into Black and Hispanic communities with subprime predatory loans, and there were banks that pursued marketing those loans in the Black church. It's like, that's not what we're talking about. It's not just getting any mortgage. It's getting a mortgage that's going to help you get ahead, so that home ownership drives your long-term financial security and builds your wealth. And I think we're going to need non-traditional lenders and non-traditional actors to do a bunch of that work, because it's not, I just don't think the big banks are going to do it on their own. Who wants to originate, an $80,000 mortgage in Cleveland? It's hard to make a living, you know what I mean? Someone needs, like a CDFI, or someone who's committed to doing that and wants to reach underserved people. We need to build that field, or we're not going to make a dent in this problem.
Yeah, thank you for that, Mike. That's good points that you raised there. And Noel, from the perspective of NeighborWorks America, how are low-income communities being impacted by housing insecurity? And do you see a large shift on the horizon?
Thanks, Tony, and thanks, Bernal and Mike, for painting that background and providing that context. I appreciate that the New York Fed is hosting this discussion and giving NeighborWorks America an opportunity to share our experience working on these critical issues. Just some brief background: NeighborWorks America is a trusted congressional chartered partner that works to improve the wealth and the financial well-being of communities across the country. And it's through our network of nearly 250 organizations that we work to create and preserve and invest in equitable and affordable housing and wealth building through things like housing counseling and home ownership, and building the capacity of our network. In terms of how low-income communities are impacted by housing insecurity, it helps to paint a little bit of a picture about today's state of America. The 2021 NeighborWorks America Housing and Financial Capability Survey, which we do to collect information and national data on attitudes and experiences of consumers, gives some insight into home ownership and housing insecurity and financial preparedness. And it found this year that 51% of households are more focused on paying everyday expenses than on long-term goals, and that socioeconomic disparities persist in people's financial preparedness. Not surprising based on some of the things that Bernal's talking about, but bank accounts, credit cards, long-term savings, these are rare assets for low-income communities or low-income households, and in some cases for people of color. It helps to know that COVID-19 created financial hardship in 1 in 3 Americans, half of which expected to take at least a year or more to recover from. It's just thinking about that, what that means in terms of home ownership and their abilities moving forward. Nearly 3 in 10 have had financial applications denied because of their credit score, and a similar percentage have delayed financial decisions for reasons related to their credit score. And those percentages are disproportionately higher among Black and Hispanic households as well. And only about 1 in 3 non-homeowners are aware of down payment assistance programs or home buyer education programs offered by their local banks or credit unions. So there's a lack of knowledge, a lack of knowing where to go for those resources. And on top of that, it's important to point out that housing insecurity is growing. Foreclosure and eviction moratoria have ended, and there are more families who are struggling just to figure out what their options are to stay housed, let alone to think about home ownership as a new opportunity. And NeighborWorks is playing a critical role, which I'll talk about in a little bit, to remedy some of that. So we're deploying millions of federal dollars to connect homeowners and renters with housing counselors. But that's just a bit of the picture to keep in mind as we talk about this.
Thank you, Noel. That was helpful. So, Noel, I want to stick with you for a second. Based on your comments, I think it would be very helpful to learn more about how organizations can help create homeownership opportunities around the country. So with that in mind, would you mind kicking off this part of the discussion by sharing the capacity building efforts you are undertaking in partnership with community-based organizations to ultimately support homeownership as a path to wealth building?
Sure, thanks. So for 40 years, NeighborWorks America's approach has been to support and build the capacity of local and regional nonprofit partner organizations in our network. So it's through them that we work to create these opportunities to help people live in a safe and affordable home, improve their lives, and strengthen their communities. And our network is unique. Some things that come to mind, it's high impact, it's locally oriented, and they're resident led. So what does that mean? So I say high impact, it means our network includes the strongest community development and housing organizations in the country who are held to rigorous standards and reviews. And our organizations offer local services and local approaches to meet the needs of their communities, to meet those challenges. And a third of any of our network organizations boards represent local residents. They have voices. Their voices are critical to the success of our projects. So we really tie that back to what's going on in the community. How can we represent that in the organizations we support? And capacity building is really about supporting and building the reach and the ability of the organization to meet the community needs. So NeighborWorks America provides our network organizations with financial and grant support, training, technical assistance. We provide technology tools, even executive leadership support when people are transitioning, for example. And all of this with the goal of amplifying their work, supporting them to expand and offer new services, or even helping them cover daily business expenses, especially during difficult times. I'd note that during COVID, many network organizations shifted to have to respond to urgent community needs. So they were out there on the ground providing vaccination efforts, food security, health services, and that's on top of their regular offerings, things like homeownership education and counseling, eviction prevention, foreclosure mitigation, lending. And two specific examples come to mind to really sort of illustrate the impacts of capacity building. I think Mike had mentioned this before, but NeighborWorks America has a dedicated CDFI capacity building initiative. And it really helps network organizations become certified community development financial institutions, or CDFIs. And with that, they can gain access to federal and private dollars that allows them to boost their ability to make needed impacts in their communities beyond what they could do beforehand. So, for instance, through this initiative, we recently worked with Neighborhood Housing Service of New Haven in Connecticut. We walked them step by step through the CDFI fund application process, guided them in how to really showcase the impacts that they already make in their community. And as a result, they were awarded federal CDFI dollars, which they're using to get their full CDFI certification so that they can leverage private investments. And they want to build a track record for lending that complements their existing strong real estate development program that they have. And together with those two programs, their goal is to increase Black home ownership in their local neighborhoods. Another recent example is our housing stability counseling program. So I think it was Dunhoon and Paul at one point were talking a little bit about forbearance and what's going on as a result of COVID. It's really critical, especially right now in this field, to remember we can't just think about new home ownership opportunities to low-income families, but we have to ensure that the families who are in homes are supported and sustained to stay there. So Congress entrusted NeighborWorks America to deploy these federal dollars to approved intermediaries, state housing finance agencies, and our network organizations so they can provide direct housing counseling services to struggling homeowners and renters facing eviction and default and foreclosure and other housing instability. We awarded over $88 million to about 128 agencies throughout every state, including DC and Puerto Rico and Guam. And we anticipate about 80,000 people across the country will receive HSCP counseling as the program runs through early 2023. And these are just some of the ways that NeighborWorks supports capacity and reach of our network organizations.
Thank you for that, Noel. Getting your national perspective is extremely helpful for this conversation. So, Mike, can you share how your organization supports current homeowners facing financial hardships and or navigating the mortgage forbearance process?
Yeah, well, during COVID, I mean, Homewise is a seller servicer to Fannie Mae, and we originate the first and the second mortgage, typically for home buyer and down payment assistance, and we retain servicing. So we service $500 million worth of loans. Not a huge portfolio, but you know, it's still significant. So during COVID, like, you know, there wasn't anything for our realtors to do because no one was looking at home. So we said, well, let's retrain them to do servicing calls. So servicing just changed, right? Like, so to explain forbearance, and at the time, if you remember, forbearance, it's really clear how it's working out, and the presentation earlier was really helpful on that front. But at the beginning, it was not clear if it was going to be a whole year. It wasn't clear that you're going to tack the payments onto the back of the loan, or are you going to have a year to repay it all? And so it was like, you know, people were afraid and scared. So you had to walk them through that and help them be patient. This is unfolding. We'll keep you posted. The other thing we had to do is train people to tell people how to go apply for unemployment insurance, because most people hadn't applied for unemployment insurance, and self-employed people didn't even think they were eligible. So we had to do some education around that. That helped a lot, right? If people could get the unemployment and the bump that came with that. So this hands-on servicing became really important, helping people navigate. The other thing we realized, and this relates to the refinance presentation that was made, was we realized, well, you know, people are buying a home in March and April, and we weren't getting phone calls about this at all. So what do we do, right? We're not going to be originating loans to help people buy homes. It's like, God, interest rates are so low. People could save a lot of money in refinance. So we typically do like 5 refinance loans a month. It's not a big part of our core business. We reorganized that and retrained people on that, and came up with an analysis tool that says here, so we could call someone and say, because these are people that we already have a relationship that we service their loans. It's like, you know, you could save $144 a month and it wouldn't cost you a penny out of pocket. Do you want to do that? So we went from 5 refinance loans to like over 60 a month. And the other thing that we noticed that was like the big lenders, because they were so busy because refi was such a big boom, they were marking up their interest rate. They were charging it up. Like Quicken did, Better Mortgage did. And I was surprised at how hard it did. But that, I think, is the way they managed their pipeline, right? Because they didn't have enough capacity to do all this, so let's just price it up. Well, we didn't do that. We just made sure whatever that pricing was got passed on to. So they saved a lot of money that way. It was really, and if you care about wealth building, lowering your interest rate and increasing the amount of that payment that's going to your principal payment, paying it off earlier, is really good for wealth building. So this is why I think non-traditional lenders and CDFIs and NeighborWorks organizations and groups like Burnell's is like, because that is the mission. It's a double or sometimes triple bottom line. It's not just maximizing financial return. It's about helping people build wealth and becoming more financially secure. It's an important sector we need to build. There's not enough organizations doing this kind of work.
Great points, Mike. Thank you for that. Same question for you, Burnell. How does Impact Brooklyn support current homeowners facing financial hardships and are navigating the difficult mortgage forbearance process?
So, you know, just as everyone has said, everyone deserves safe, affordable housing and the opportunity to own a home if they choose. But as important, everyone deserves to remain in their homes. And I used to run NHS of New York City. It is a community development financial institution. Before I left, I actually arranged for us to be able to originate first mortgages. We, for a long time, did renovation rehab loans, and hopefully that continues today. It's been a while since I've spoken to the folks at NHS of NYC, and shout out to Susan Eiffel, who followed me and is now the Chief Operating Officer at NeighborWorks America. But also in New York City, we have networks that have come together. The Center for New York City Neighborhoods was formed years ago to address the issue of foreclosure and continues to do the work to assist the network of counseling agencies, HUD certified counseling agencies, to be able to provide guidance to families. We also work with the New York Mortgage Coalition, and a great shout out to the Attorney General of New York State for her support in helping us to be able to continue with legal services and counseling for vulnerable New Yorkers. We know that forbearance offers home ownership temporary relief from mortgage payments. This was especially important during this time of pandemic. Many of our homeowners benefited from the relief provided by the CARES Act, and homeowners are now trying hard to get back on their feet. We understand how difficult navigating this terrain is for people, and we want to keep people in their homes. So, what we're doing specifically at Impact Brooklyn is that we are educating, counseling, and building the confidence of homeowners with the knowledge that they need to fight back and to navigate the system. We're helping people facing foreclosure, tax liens, and other mortgage issues, largely through our counseling efforts and our loss prevention programs.
That's great. Thank you so much, Burnell. So now I want to spend the rest of our time uplifting more on the ground solutions. So Mike, can you kick us off by explaining how your organization developed the smart homeownership promotion strategy, and what major points are you correcting through this program?
Well, I think, you know, the genesis of this is when we kind of figured out that, like, there really is not a home purchase process. There's not one process. There's really a mortgage origination process, a real estate sales process. There might be a home buyer education process, and it's all disjointed and unaligned, right? So I mean, the image I think of when people buy a home in America, it's like you're entering a pinball machine, and where you start is random. Where you go next is random. It depends. You go talk to your uncle because he bought a home? Do you talk to a bank? Do you talk to a realtor? What do you how do you start? You talk to a HUD counseling agency. And so the Homewise thing is, can we make that a more seamless process that's better aligned and provides greater peace of mind for the home buyer through the process? Because even when it goes well, it's a nerve-wracking process. It's a big deal. So we want to be the point of entry when people are discerning whether or not to buy a home. Some people, it doesn't make sense for them to buy a home at that stage of life. So that, like, there's this discernment thing. It's like, okay, for most people, it does make a lot of sense to buy a home in most places. And then, okay, well, 75% of the people that come to Homewise can't qualify for a good mortgage when they come. In the old days, they might have qualified for a subprime mortgage, but we always said, like, well, why do you want to pay $300 a month extra when all you got to do is pay your bills on time for a while and you could get a really good mortgage? So we do what we call that home buyer preparation, so that we're preparing people to get a good mortgage. Once they are able to get a good mortgage, and we've established their purchasing power based on their income and debt, then they go look for a home. We have realtors on staff who are salaried, non-commissioned, so they can help people. There's no high pressure because they spend the same amount of time with someone buying a $100,000 home as buying a $250,000 home. In New York, those numbers would be different, but not in upstate New York. And so so then, but they can use another realtor if they have somebody they want to work with. And then we put all the financing together. So our mortgage is typically a conventional mortgage that's below 80% loan to value, the first mortgage. If they're eligible for down payment assistance, kind of the freebie money, that we bring that to the table. And then the rest of it, and they bring 2% total for both down payment and closing costs, their contribution, only 2%. Way less than, FHA requires 3.5% plus closing costs. It's way less than that. And then we loan the rest of the gap in a second mortgage, and the amortizing second that they make a monthly payment on. By doing it that way, you get rid of mortgage insurance costs, which saves a lot of money, which increases their purchasing power, or the payment's just lower. So that's really good. So the risk in that is we've stepped into the mortgage insurance role, essentially. So there's a default. Our second is what takes the hit. But our delinquency rate last quarter was like 1.44%. That's over 30 days late. Fannie's around 3%, FHA's around 14%. So I think it's because we have this integrated, seamless system. It's a whole product approach to home ownership. We would say we're not marketing realtor services or lending services. We're marketing home ownership. And so because of that integrated set of services, homebuyers perform very, very well over time. And that's good. It's good for them. And that's the last thing I would say about that is I think it's important that we look for ways that everybody in the process that's helping someone buy a home has a stake in the long-term performance of the buyer, not just a stake in getting them in a roof over their head, close it on the mortgage and you're done. So because we have a second mortgage on this, we're really invested in them being successful, because if they default, we got a problem too. And I think that's a good thing. I think rather than do more studies on why homebuyer education has a positive effect, I think what we should do is we need to figure out how to align that part of the system, that there's rewards and there's losses if people don't perform. Another way to put it is we need to put our money where our mouth is and really invest in the long-term success. Because the goal of this isn't just to provide shelter. The goal of this is to build people's wealth over the long term.
Yeah, that's great, Mike. Thank you for sharing what you're doing in New Mexico. That's really helpful. So I'd like to go to Burnell now. So in your view, what type of programs aimed at preparing families for homeownership have been successful?
So it's interesting, Mike. Thank you for saying again that you're in it for the long haul, because many people buy property without preparing themselves for the next steps of homeownership. And after they purchase, how do they keep their homes? So what has been successful really across New York is that really helping home buyers ensure they enter the process knowledgeable. So the whole counseling on a range of important issues like property tax, loan repair, repair loans, mortgages, just how to maintain your property, but also protecting against scams and deed theft. During the pandemic, we also know that unfortunately, so many families have the breadwinner, lost because they felt ill and passed away due to the pandemic. So the importance of estate planning, we don't have that, and again, I always think about CRA and where, financial institutions can check the box. Check the box if we're really helping with having lawyers and support to be able to understand how do you transfer that wealth, and having the wills and the trust and the estates all set up, and doing that for working families. So we're hosting forums that provide information to homeowners about trust and estates and the conveyance of wealth. Our goal is very simple. We want a community of savvy, self-confident homeowners across Brooklyn and other boroughs who can maintain their properties and retain in their homes for generations. I will have to add too that along with education, the provision of down payment closing cost assistance programs that target first generation home buyers also help to advance economic mobility and racial equity goals. So New York City, through the Department of Housing Preservation and Development, has increased its down payment closing cost support to $100,000 for families at 80% of AMI. So a family of four making $95,450 can get up to $100,000 to help them buy a home. And I think this is significant to really understand what is the cost of housing in New York City, and being able to have the government really step up and support. So we help with that application process and to move things through. And the waiting list is really long for this particular program.
Yeah, I'd imagine so. But yeah, and thank you for clarifying that. I remember during our prep conversation, you mentioned the federal distinction doesn't always do cities like New York any favors, because you're not just dealing with low income home buyers, but you're dealing with low, moderate, and middle income home buyers because of the lack of affordability that we're experiencing in this city. So that's really important for people to know.
Thank you, Tony.
Sure. So, Noel, given NeighborWorks' extensive national network, I'd like to give you an opportunity to also share your thoughts on this particular question. Are there programs across the country that are successful assisting low-income families obtain homeownership?
It's about to go into my examples I want to share, but for now, made me just remember, and it's probably helpful, especially for those on the call, to understand that, in New York City, low income breaching into moderate income, that's a police officer and a teacher. That's a household right there. So I think it helps us just stop for a second and remember who we're talking about, and then to sort of think of some of these examples. But two particularly impactful initiatives that NeighborWorks is leading in this area come to mind as we're talking about this. And we have those people in our heads now we're thinking about. First, we've launched an initiative on advancing minority home ownership this year. And increasing home ownership in communities of color is part of our strategic plan, and also a critical part, quite honestly, to our network organization's just daily work. Our network already has a successful track record of serving and creating sustainable communities of color. And over half of our home buyers that are reached by our network are people of color and have low to moderate incomes, which is greater than what the overall market serves, as reported by HMDA. So it's helpful to remember that. And we wanted to further invest in successful local strategies that create minority homeowners. And so we're doing that by first identifying what exactly is our network doing that makes them so successful in this, which strategies, which best practices are critical. And then we're providing some space for peer sharing among those organizations so they can really learn from each other, see what solutions work best in certain regions or under certain circumstances. And then we're going to go out and we're going to share that information with our network and broader and more broadly, and look for opportunities where we can scale those solutions out to support further growth in minority homeownership. So that's like a structural approach that we're trying to take to figure out how to address these issues. A second particular program that comes to mind that we've sort of touched on is something I'm really proud of. It's called Let's Invest for Tomorrow, or LIFT. And it's NeighborWorks America's down payment assistance program, which in partnership with our network and Wells Fargo has created nearly 25,000 homeowners. Nearly 2 out of 3 are people of color. And it's administered over $379 million in financing. Down payment funds continue to be one of the most critical obstacles for borrowers trying to achieve home ownership, and NeighborWorks excels at deploying these funds to support sustainable homeowners for low-income families across the country. And I just add, I want to echo what Mike and Burnell have been saying, which if you think back to the earlier panel, and they're talking a little bit about forbearance and refinancing and trying to reach some of these communities, and what those numbers are not equal as far as getting those additional opportunities to increase their wealth. This really is where those local organizations on the ground can be so critical and make that difference. Just because we have a solution or an entity has a solution doesn't mean somebody's going to pick up and use it right away. You really have to start with that trusted relationship where people know to go, where people don't feel like they've been burned before. There's a lot of history from the financial crisis and before, which is showing people to sort of back off and not want to engage in the mainstream financial system in some of the ways where their white counterparts might do. So it's really important to match up those opportunities with the people who can deliver those and make that message pretty clear and the impacts understood.
Great, thank you for that, Noelle. That's all very helpful as we navigate this process. So actually, we have limited time here, but as a parting question, I want to ask, what's the one key takeaway you'd like for everyone to remember for this discussion? And given we are a little on time, I like to ask you all to keep it at 1 minute or below, if you don't mind. And anyone that would want to volunteer, I don't want to put you all on the spot, but if anyone that would like to volunteer your insights.
I would say that I think, like I said before, I think we need to invest in this alternative delivery system in home ownership. And I think one thing that we could look at, a concrete step, would be asking the CDFI fund to create a home ownership finance fund Similar like the Healthy Foods Finance Initiative, like there was no CDFI financing grocery stores, hardly any 15 years ago. Now they're financing grocery stores and food deserts all over the country. I think if we made that kind of investment where you could capitalize CDFIs to focus on home ownership, I think you would grow capacity of the field.
Thank you, Mike.
I'm going to jump in and just say the one thing is to really think about maintaining home ownership and what can we do, and looking at some structures, because again, I think, having once been a banker and looking at the Community Reinvestment Act, a lot of it is the promotion of home ownership and not necessarily the retention of home ownership, and really wanting that to be thought about. Let's make sure there's significant credit given if you're helping with wills and estates and foreclosure intervention and all of those things. So for me, it's really being able to maintain home ownership.
Thank you, Purnell.
And I would just add on a little bit about, as I said before, I think for those on the call who are listening and thinking about what they, and their event with and take back to their offices, and they're thinking about it, is how can you take your organization and actually make those impacts in those communities? What else do you need to do that? And there's a lot of people on this panel right here who connect you to those organizations that can bridge that divide. I think there's a lot of opportunities that are out there right now, but it's a matter of making sure that opportunity gets connected to the people on the ground that really need it. And there's many here that can help on that. So NeighborWorks America is happy to be that partner, and I know the others as well. Thanks, Tony.
Thank you, Noelle. Those are great parting words. And so, unfortunately, we are out of time at this point, but I do want to thank Purnell, Noelle, Mike for their insights and thoughtful discussion on fostering homeownership in low-income communities. As we've learned, there's a lot of great work happening on the ground to prepare people for homeownership and to keep people in their homes during challenging times as well. For those of you watching today, please feel free to reach out to any of us if you have any questions related to what was shared during today's panel discussion. So thank you all for joining, and back to you, Teresa.
Thank you.
Thanks, Tony, Brunel, Michael, and Noelle for sharing with our audience the social economic barriers as well as the solutions your organizations are working on to increase, maintain, and retain homeownership across low-income communities. Your work is critical, and we appreciate you joining us and sharing your insights today. Now I'll turn it over to my colleague, Janice Frenchak, who will moderate our financial services panel. Over to you, Janice.
Thank you. Welcome to the financial services discussion and our conversation on home ownership and equities. I'm Janice Frenchak and lead the Consumer Compliance and Consumer Protection and Community Reinvestment Supervision Department at the New York Federal Reserve. And we're going to focus, I think, this panel on the financing aspects of home ownership, including, as we heard earlier, opportunities for home preservation. And I really hope in this conversation we have a really candid discussion of some of the logistical obstacles and barriers, as well as suggested solutions to those barriers from the financing side. So want to welcome our panelists today. First, we have Jay Bacow, who is a managing director and co-head of the U.S. Securitized Products Research at Morgan Stanley. Next, we also have Sarita Battles, who is a managing director and head of community and affordable lending at JP Morgan Chase. And then also we have Patricia Sampson, who is a vice president and manager for fair and responsible lending at Popular. I don't see Patricia up yet, but I'm sure she'll be coming on shortly. I'd just like to welcome all of you, express really deep appreciation for all of you attending and engaging in this conversation. You'll have a great deal of experience and subject matter depth, so just very excited to have you all with us here today. I'm just going to jump right in because I think, we've just got, a limited amount of time to engage in, I think, a very, very substantive and important discussion. And that's, really thinking about some of the financing opportunities as well as some of the financing obstacles to increasing and preserving home ownership for low and moderate income individuals, and really with the focus towards the financial markets and the financial products that are in existence today. I think, we heard quite a bit from our first panel about the research done, a lot of the barriers and challenges, just from the sheer data perspective. And then I think from our second panel, we just heard some very specific challenges at the individual and family household level for low income home ownership and preservation, which I think, we heard very loudly and clearly is a key component when we think about wealth building and resolving some of the inequities that exist today. So I'm just going to ask you, Jay, if you don't mind kicking us off here. I know that Morgan Stanley has done some very similar research, and I'm wondering if you can give us a summary of that and some of the, either similar or dissimilar findings that you guys have uncovered in the research that you've done.
Absolutely. Thank you for the opportunity. Obviously, we're working on some of the similar data sets as the researchers at the Fed, and so we've clearly seen some similar results. The COVID pandemic has really brought both the racial and socioeconomic inequality into sharp relief for many people, and it's catalyzed a lot of the research efforts on this topic here at Morgan Stanley. And one of the things that we've been focusing on is the racial disparity in access to homeownership in the US. This exists elsewhere as well, but we're just going to focus on what's going on in the United States for this call. Obviously, homeownership is one of the key fundamental building blocks of wealth creation in the nation. And the divide between those who own a home and those who do not own the home has only grown starker during the pandemic, with homeowners experiencing record home price appreciation, while renters have not only missed out on this home price appreciation, but also seen their rents go up. Low-income households and minority households are also significantly less likely to be homeowners. When we look at it, breaking it up on the income side, only half of the bottom 20% are homeowners, while 80% of the top 20% of the income brackets are homeowners. When we break it up by race, 72% of white families currently own their home, compared to 61% of Asian families, 48% for Hispanic families, and just 42% for Black families. There's a clear divide here. This racial gap in homeownership, it contributes to the racial gap in wealth as well. The median net worth of a typical white household pre-pandemic was $188,000. This is 8 times the median net worth of a typical Black household at just $24,000. When we account for all the differences in the household characteristics, age, income, education, household structure, we estimate that if you could close this racial gap in homeownership rate, we would generate almost 5 million more ownership households. This would result in 800,000 long-term jobs and about $4 trillion in tax revenues. There's a huge impact where everybody wins. Now, part of the reason that we're seeing this homeownership gap may partially stem from the fact that Black and Hispanic households are simply denied a mortgage at a higher rate than white households, which was addressed a little bit earlier. In 2020, white purchase applicants were denied 8% of the time, while Hispanic applicants were denied 13% of the time, and Black applicants were denied 19% of the time. Now, these are absolute numbers, but this racial gap exists in denial rates when we control across the credit spectrum. And in COVID, we saw the Black-white gap in denial rates rise across the credit tiers, reversing 7 years of progress. When we look at this Black-white purchase denial gap, it's highest in the South, it's lowest in the West, but poverty is also a compounding factor to this. We put out a recent report looking at the HMDA data in 2020, and we saw that minority borrowers bore the brunt of the tightening in financial credit conditions. We also have an interactive tool that anyone on this call can look at to see and filter the data as they want to. But even when you control for the fact that it's more difficult for Black and Hispanic borrowers to get approved for a mortgage, as was mentioned earlier on this call, once they get the mortgage, they pay a higher rate on refi and on purchase and across credit tiers. We get this data from the HMDA Act. They give a rate spread, and we can see that this spread exists where Black and Hispanic borrowers have about 5/8 of a rate, 5/8 of a point above the white borrowers. This finding we hold across credit spectrum as well. So not only is it harder for Black and Hispanic borrowers to get approved for a mortgage, once they get that mortgage, they're still paying an above market rate. So this just makes this compounds the problem. I know you said we're limited time. I could go into this for much longer, but I'll pass it back to you.
Thanks, Jay. It just fascinating work, I think, too, kind of underscoring the earlier points about how generational challenges impact, as well as I think the really powerful point of what the economic power and contributions could be if we really think about solutioning for some of the gaps here. Just really fascinating points. I saw Patricia come on for a minute. I'm not sure if you're here, but I was going to toss a question to you if you're available.
I am. I don't know why you can't access the video. I'm working on it, but I'm happy to speak. Thank you for having me.
Yeah, no problem. I think we've all experienced these trials over the last 18 months, so we will just move on with a lot of grace and engagement. So, Patricia, the question I really wanted to pose to you is really about the unique nature of your organization, where you have operations both in New York City and in Puerto Rico. And so I'm wondering if you'd be willing to share, any unique aspects in terms of home ownership and preservation disparities for your customer base, and even with an angle, an understanding, and maybe communication for so many here today of how that was particularly relevant, thinking about some of the recent challenges, the natural challenges in terms of earthquakes, hurricanes, the pandemic, and how that's impacted your customer base.
Yeah, happy to share some of the information. So in Puerto Rico in particular, so we have, of course, that we have banks both in the US and Puerto Rico. And in Puerto Rico in particular, some of the challenges to home ownership, especially following the earthquakes and I'm sorry, I have technology here with me as well, so you should see me shortly. The earthquakes and hurricanes that occurred in Puerto Rico, it's the rehabilitation challenges that homeowners had in Puerto Rico. Homeownership is also unique in Puerto Rico in the sense that as an island, there isn't enough inventory there. To build on property. So they're building up. And in terms of building up, it's like more condos or what have you that allows low and moderate income individuals to participate in home ownership. Because of the uniqueness within Puerto Rico, there are challenges to title, for example, because if a family has a large piece of property, they may be building on that property and have other family members build on that property. And oftentimes it isn't part of, they don't have the permits associated with that. So when it comes time to resell to other homeowners, there are challenges to home ownership in that way. So it's very unique, different challenges than they have here in the US because of that.
Thanks. I think there are a number of I think cities and I was reading something not too long ago about New Orleans and having some of those same challenges as well in terms of passing along title and pieces like that. So that's very helpful. So Sarita, I'm gonna toss this one to you, and I'd like to bring in the discussion to the recent pledge from J.P. Morgan Chase. Last year, your organization announced a $30 billion pledge towards racial equity. And there are so many components to it, but I think there's two that I'd really like to ask you to speak to. And one was the commitment to originate an additional 40,000 home purchase loans to Black and Latinx households, and committing, another 8 billion in mortgages. And the other piece was really around helping an additional, and I think, from the prior panel, or the prior two panels really about refinancing, helping an additional 20,000 Black and Latinx households achieve lower mortgage payments through financing initiatives. And through that, you guys are committing to another 4 billion in refinancing activity. So the question that I have for you is really about some of the inside baseball around this. How did you guys think about developing these initiatives? And I think, the other piece is, uh, you could say that this is a bit of a departure from kind of the traditional way of operating in this space, not necessarily for your institution, but just kind of thinking at a broader level. What were some of the logistical challenges in terms of anything that you might have experienced in pushing these initiatives through, and the ways that mortgage and refinancing markets operate?
Well, first of all, thank you and good morning, and appreciate the opportunity to be on the panel. And let me just first say, I think one of the biggest, and I wouldn't say it's a logistical challenge, but I would also say it's an opportunity. I think one of the first things to note is that this commitment came from the top of the house. And so when Jamie Dimon says, that we want to make a commitment in this particular space and we want to close the racial wealth gap, coming from a top down instead of a bottoms up approach makes all the difference in the world. And so I would say that's first and foremost, is that our leader is dedicated to this commitment and has been over time, but really wanted to double down and lean in into doing something different to make significant impact. I will say that this is a 5-year commitment. And again, we started it at the top of this year. And there are obviously different components of that $30 billion commitment. But the fact that we have 12 billion specifically focused on advancing homeownership, because we know that homeownership is a significant component in closing the wealth gap, as well as also creating generational wealth and legacy. And so as a firm, as you were speaking, you said an additional 40,000, an additional 20,000. We wanted to go above and beyond what we've done as a lender, and then also hold ourselves accountable to lending more to Black and Latino individuals, families, and communities. What we do know is that there is no single tactic, product, and or program that will close the gap and win the trust and consideration of these communities. And so understanding that just out the gate, like there's nothing that we can build and just say that because we built this, we're going to close that gap, so on and so forth. So what we've done is we've taken a multifaceted approach by focusing on 6 key pillars that we feel that are in some cases basic blocking and tackling when you think about homeownership and driving that. But then these are also things that are foundational to our ability and other lenders' ability to be able to really double down on this and lean in. And so one of our first pillars is really, focusing in on attracting, retaining, and developing the diversity of our sales and operations talent. We need to make sure that we're hiring people that represent these segments and communities that we're seeking to serve. But more so than just hiring them, making sure that we create performance and compensation strategies that encourage and promote the advancement of homeownership, regardless of the dollar amount. And so there are some things that we've done specifically around hiring and creating a group of community home lending advisors that we have placed in minority and LMI communities to be able to not only just serve those that are a part of our bank, but serve the surrounding community that they are operating in. The other thing that we have to do is make sure that we're in a space of being visibly and actively present in these communities. And that means that we have to leverage all of our sales distribution models. That's what I love about JP Morgan Chase, is that we have several distribution models to be able to serve customers when, where, and how they want to be served, whether it's going into the bank, whether it's working with a loan officer that's in market, whether it's picking up the phone and calling one of our loan officers that's centralized, or whether or not it's digital and mobile capabilities, just to be able to connect with us and do business with us. The other thing, and this is what I think about being a part of this panel that's important, is that we have to build and deepen relationships with key influencers. I was listening on the call and heard Noel talk a little bit today about some of the things that they're doing from a home buyer education perspective and how they're creating awareness and really preparing people for home ownership, whether that's pre or post counseling. But it's important for us to continue to build and deepen those relationships with those types of nonprofits that provide housing counseling, realtors, builders, advocacy groups, those that have a stretch into the communities that we're seeking to serve. As you notice, I'm not really talking about product, but I am going to mention product now because it is important for us to have tools and resources available to create access to credit. And what I like to say is that we offer an array of products and programs to meet the full economic spectrum of our customers. Where we've doubled down in, or where we have said, you know what, we want to be very specific, is that we've leveraged what we call the special purpose credit program. And we've leveraged it like a grant, where we're providing a $5,000 grant specifically in Black census tracts and lending tracts across this country. And so that's a big deal because, again, we're being very specific based on the specific needs. And then we measure the effectiveness of that special purpose credit program to see whether or not we need to do more or enhance it or make sure that we're doubling down and that it's making the impact that we intended for it to make. When we talk about marketing and promoting and doing different outreach events, it is necessary for us to inform, educate, and dispel myths and create awareness around homeownership. I always say that when we know better, we do better. And in these communities of color, when you think about declination rates and things of that nature, a lot of that can be avoided if they're prepared for homeownership. So those partnerships with those nonprofit housing counselors are extremely important to make sure that people are prepared and are informed. The last thing that I'll say is, and it's just really centered around policy. So when you think about all of this that we do, the undercurrent is really making sure that we're participating in policy reform that really addresses the systemic barriers to homeownership, like the lack of affordable inventory, appraisal gaps, student loan debt. We're at the forefront of that, working with the GSEs or the agencies, Fannie and Freddie, working with the regulators on Project Reach, working with other collaboratives to talk about what can we do together collectively to make sure that we're meeting these specific needs. And then one other thing I'm going to say, and I'll stop here, is when you talked about logistical challenges, the one thing that I would say is it is going to take a village. Most often when we change our outlooks, we'll change our outcomes. And so it's going to take all of us working together across the entire industry to make sure that we're able to close this racial wealth gap. And so again, that's a challenge, but it's also an opportunity for us. But the thing that I would say is that the first thing or the first step in this process is just to start. And that's what we've done here at JP Morgan Chase. Is we've just started and said we're going to hold ourselves accountable to doing more in this space. And I would encourage everybody else to think about that in those terms as well.
Thank you so much. The approach is so multifaceted, and in terms of really thinking about individuals, thinking about partnerships, thinking about policy. And so I think none of us think that this is something that is a simple solution, but it is both micro and macro, I think, in so many ways. And I think this panel in particular, I think there's opportunities to really get into that discussion a little bit more wholesomely, and we will. I do also want to ask you, Patricia, in a very similar way. Are there particularly successful programs that your institution has developed, or ones you would have wanted to put forward but faced some real challenges in making that happen, not even just at the institutional level, but just kind of at that more macro level, as I was mentioning?
Yes, I think there are several opportunities that we can engage in that for various reasons we are at a disadvantage. Certainly in the US in particular, our bank is a lot smaller than it is in Puerto Rico. But in the US and in Puerto Rico, we leverage Fannie, Freddie, FHA, and the Federal Home Loan Bank products. There are other opportunities that we seize on. For example, we do have a CDFI that focuses on new market tax credits, and we have supported a supermarket within New York City for food insecurities. With respect to lending activity, oftentimes there is challenges with respect to safety and soundness compared to the special purpose products that you'd like to be more involved with. In our case, in the US in particular, we've identified a couple of key areas where we feel that we can be impactful. For example, one of the challenges to homeownership is certainly in the low and moderate income individual, in the low and moderate income space, as Bernal and others have talked about, it's not only the down payment assistance or the closing assistance, but oftentimes applicants are not really ready for home ownership, either because of FICO scores or even being unbanked or underbanked. And one of the products that we've developed at Popular is a credit builder product where the applicant or the pre-applicant will have access to a secured loan that develops that credit relationship that affords them to come into the banking world, and in addition to start building that those other assets that can get them towards home ownership. We are also unique in the sense that we are in Hispanic neighborhoods. A lot of our branches are in Hispanic neighborhoods, and the language barrier is also part of the challenge to home ownership. So we've ensured that there are Spanish-speaking people in in most of our branches. And lastly, when we look at activities, I think one of the challenges is this dynamic between, as lenders think of below market as affordable, but we know, especially in the CRE perspective, the HUD affordability tables doesn't necessarily align with the with below market rates. And as such, there is also that tension between safety and soundness and ensuring the risk of a transaction and getting that loan through the pipeline. I'll stop there. Hopefully I've addressed several issues in my response.
No, you've done great in sharing, I think, some of those unique perspectives and realities, right? In terms of what are some of the challenges in pushing or promoting some of the products that you'd like to, with, the tension from, making sure that your institution is running in a safe and sound manner. As you talked about the credit builder program, I'm going back to the earlier panel where, one of the panelists shared that, for his son, they had a credit card during college, that they helped him build that credit. And I don't think you can underscore enough how important that pre-credit, if you will, that pre-mortgage credit helps to really position people in a way to have kind of a successful application for home ownership. So Jay, I'm going to turn to you, and I think Morgan Stanley has also done some really interesting work in recent publication this year in February, which I think we're still trying to figure out the logistics on and getting it out on the site. So just reiterating the invitation to come visit the site after this event. But you had some positions around opportunities for expanding access to home ownership, and really some specific recommendations or suggestions around how the Federal Reserve might operate in order to facilitate, some of these markets. So I'm wondering if you can get into those specific recommendations, but even before that, maybe giving a lot of us a little bit of a 101 in terms of how these markets work, so that we can kind of make those connections as well.
Sure. So what I spend my days doing when I'm not on these calls is analyzing a market called agency mortgage-backed securities, which was earlier referenced. Agency mortgages are mortgages to homeowners in the United States, and the default risk of the homeowner is insured by what we call the agencies, or Fannie Mae, Freddie Mac, and Ginnie Mae, which were referenced earlier. Given that Fannie Mae and Freddie Mac are in conservatorship, and Ginnie Mae is explicitly guaranteed by the United States government, what that means is that investors in the agency mortgage market aren't taking any credit risk. So if the homeowner defaults, the investors get their money back. Beyond the lack of the credit risk, what makes the agency mortgage market special is the liquidity. We often view it as the second most liquid fixed income market in the world after US Treasuries. And that's because what originators can do is take a bunch of similar loans that originated around the same time and make a pool of them, get them guaranteed by the agencies, and then sell them into the market as a liquid futures contract. This allowed market participants to facilitate the risk transfer of agency mortgages without looking at each individual loan like they would have to do in the non-agency market. This allows originators to more easily and cheaply hedge their portfolios, which reduces the mortgage rate to the homeowner being lower. So everybody wins sort of in this scenario. To give a context of in the size of the market, in 2021, we've averaged about $14 billion of origination of mortgages every single day. And the outstanding size of the mortgages guaranteed by the agencies is about $7.9 trillion right now. When we talk about market participants, the largest one right now is the Federal Reserve through their quantitative easing program, of which they announced a taper recently. What the Fed does is they buy those forward contracts, and this allows them to purchase the $2.6 trillion they purchased so far very liquidly. However, we think there's a number of ways that the Federal Reserve could tailor or tweak their purchase patterns to more support marginalized homeowners. First, they could bias their purchases a little bit more towards Ginnies over Fannie and Freddie, given that Ginnie's mission is to serve low-income, veteran, and rural borrowers. Secondly, we think the Fed could also bias their purchases a little bit more towards the lowest coupons or the mortgages with the lowest mortgage rate. If they purchase the lowest coupon mortgages, this will more directly lower the mortgage rate to the homeowners, as opposed to purchasing more of the outstanding mortgages where there's a little bit more of an alternative benefit to investors. Third, instead of just buying these liquid contracts, they could also stipulate their purchases to target collateral and demographic characteristics, such as lower loan balance pools, homeowners with lower credit, or first-time home buyers. Lastly, I'll mention there are some new programs that may be a little bit too small for the Fed to partake in, but they could certainly try. But other socially conscious investors may want to direct their purchase towards these from Fannie and Freddie's low-income programs, like home ready, home possible, refi now, refi possible. But also then Ginnie Mae has been releasing new information around the low to moderate income data, and investors could target pools with higher percentage of those loans coming from this low to moderate income tracks. Going forward, we think it's just sort of ripe for Fannie, Freddie, and Ginnie to disclose more information, more socially relevant data behind their securities, which would help investors and potentially the Fed identify more opportunities within agency mortgages and help them incorporate in their investments to target some of the solutions to these problems.
So I really appreciate the thought and the concrete opportunities that are there. And, you know, kind of going back to Patricia and Sarita, just wondering if you have some perspective as well, listening to some of these very, very concrete opportunities that the Federal Reserve might have in terms of facilitating these markets. Whether you also have kind of either through your discussions or maybe bright ideas through listening to the discussion today throughout, whether there might be some opportunities that you see the Federal Reserve uniquely poised to move on from this perspective. So Patricia, I'll ask you first if you have a perspective on that.
I do, and in fact, I would piggyback off of what Jay has just said, because in Puerto Rico in particular, I know that there, you know, the Fed has given credit to investors that invest in Puerto Rico, and they'll get CRA credit for it. But there are a couple of challenges in Puerto Rico, especially for us as Banco Popular, because as we are actually the purchasers of many of the mortgages, and we're the ones that are creating the security for resale. What that means for us is then there are very limited opportunities for investments on the island. Investments, the new market tax credits or the low income housing tax credits tend to be more complex. And as we are the number one lender and depositor on the island, there are few opportunities for us to engage in those activities there. So I support what Jay has just said, that there are there may be other opportunities within the mortgage-backed securities area for us to if we can develop low-income individuals on the island.
Would you mind? I think you froze for a minute there. Maybe just repeating your last sentence or two.
As what I said is if we can leverage more of the mortgage-backed security space, whether it's with Ginnie or any of the other participants in that space, it will go a long way to helping us do more investments towards LMI individuals on the island.
Thanks. And Sarita, same question to you if you have a perspective.
Yeah, so my perspective is going to sound very simple, but it's impactful. And I would say that what you're doing now is critical, right? So to me, this is the start of being able to have these types of informative conversations and panels to really be able to put the information out there for everyone to be able to hear and understand and create some type of know-how around, you know, based on the data components and things that have been presented today on what their opportunities are. So I think this ability to be able to inform. I think the other opportunity is the partnership piece of it. Going beyond this type of forum, how do we come together as a collective unit to be able to talk about some of the specific needs that we have, whether it's the banking industry, whether it's the GSE, so on and so forth, but really coming together as a collaborative force to be able to talk about how do we solution for this. And then I would say the third thing is just really making sure that from a data perspective, because you guys have access to a lot of data points and things of that nature, but how do we really gain that insight and get that data? Because I will tell you, I can definitely preach and lead people to the water and try to make them drink it. But I want to be able to leverage data resources and things of that nature to be able to get them excited about this opportunity and not just seeing it as a charitable type of thing, but to see this as a true business opportunity, because that's exactly what it is. But to be able to look at the data, see it as a true business opportunity. And even though I may lead you to the water, or maybe the collaboratives lead you to the water, you will want to drink from this because it is a true business opportunity for all of us that are seeking to close this racial wealth gap. So although my statements are probably may seem a bit minimal, I would say the consistency of doing things like this and being able to work together is going to be what's going to move us from here and beyond. So those are my statements.
So I would disagree that those statements are minimal. And if I think we've got a few more minutes here, so I'll just quickly ask us, it kind of piggyback on the last point around data. I think, the use of information, right, to create a compelling argument is extremely powerful. And I think, some of what, the point that I referenced earlier that Jay made in terms of actually the economic impact of some of this. So I would maybe just ask all of you, what type of compelling data would be useful? What would you like to see, and what are the opportunities there?
And I'll just speak since I was the last one. I'm still not muted. But what I will say for me is, we look at data from a national perspective most often, and that's where we start. But I will tell you, the rubber doesn't meet the road until we go local. And so for one of the things that we've started doing is we took national insights just to get people excited and tell them about the platform and the opportunity that we had as a business. But then when we go into each market, the way in which we strategize is based on that data from that marketplace. And so again, looking at the competitive landscape, sometimes there are opportunities where people will say, go and you need to have a loan officer in this particular area. But then when we look in that area, it might be more non-owner occupied areas. So the opportunity for home ownership might not be there, but maybe the opportunity for educating folks may be there. And so being very specific and intentional, understanding the purchase mix that's going on in that marketplace. We talked about high cost mortgages. Today, a lot of that is in FHA. And a lot of people, when they see Black and Latino folks, they look at us and they think FHA is the answer without understanding our financial situation. And so when I think about things like that, there's opportunity for us to be able to share average loan sizes so that people really understand. I remember when we were going into our commitment, initially our finance guys were looking at this and they were like, okay, we're going to go in average loan size $100,000. And I'm like, when we look at the overarching data points, average loan size right now for Black and Latinos is $276,000. And so you have those that are up, you have some of those that are down. But if we go in with a mindset that this is just a low to moderate income opportunity, I think we'll miss the point here. And so again, just all of those different data points that drive people to think differently about this space requires us to do something different so that we can change the outcomes.
That's fantastic. I think we're at time, so I apologize to Patricia and Jay that I didn't get your perspectives on it, but continue to welcome them. And just want to give you guys all a very deep thank you for your insight and your experience here. Thanks again for joining us.
Thank you.
Thanks, Janice, Jay, Sarita, and Patricia for sharing initiatives your organizations are focused on to address obstacles and create opportunities to increase home ownership within low-income communities. Now I'm happy to turn over closing remarks to David Erickson, Head of Education and Outreach at the New York Fed.
Hi, everybody. I liked Janice's comment about having some patience around technology. I can't get my video to work, but I did want to just thank you all, thank the audience for joining us today. I want to thank the panelists and the speaker the speakers. I particularly want to thank oh my goodness. Hold on one second. Maybe I can get it to work. Sorry. Well, we'll just keep on going. I specifically want to thank the Fed's planning team that put a ton of effort into this event today. Raji Chakrabarty, Tony DiCario, Janice Frenshock, Brian Green, Otho Kerr, Edison Reyes, Brett Rose, Ellen Simon, Rixie Simmons, Philip Stone, Kelly Jackson, and Teresa Torres. I really miss holding these events at our building here in Manhattan. It's a pretty intimidating building as this stone castle on Wall Street. And as we gather, I often reminded the audience that you, the audience, you own this building. And this institution is designed to serve the needs of the public through our efforts to support the economy. I think that idea is really captured in our mission statement, our new mission statement, actually. The Federal Reserve Bank of New York makes the U.S. economy stronger and the financial system more stable for all segments of society. We do this by executing monetary policy, delivering financial services, supervising financial institutions, and providing thought leadership on issues that impact the nation and communities we serve. And we have 3,000 employees that stand behind that promise, and we are working on multiple capacities, research, supervision, community development, markets, and more to make an economy that works for all segments of society. And as Burnell Greer reminded us today, there is no racial equality without there is no racial equity without housing equity. And Jay Backow just now suggests that we are all substantially better off if we could solve the housing equity problem. So we heard a lot of good ideas, practical ideas, concrete ideas on how we can do better today. We will continue our commitment to work with all of you to build on those ideas and make that better future a reality. So I just want to thank you for joining us. Please stay in touch with us through our website and our newsletter. We hope to be convening on more issues like this in the future. And thanks to everyone for joining. Take care.